Risk management. This is not a subject that we only use in financial markets. This is a daily phrase that we always use. If I do something, is it safe? If I go to the road in my car, is it safe? If I fly and travel with an airplane, is it safe? So we ask this question from ourselves or the people around us during the day, directly or indirectly, like billions of times. But when something that we are dealing with is becoming already risky, we're trying to focus more on the fact how to avoid those risks by risk management, of course. In the previous session, I've talked about the risk management, how to set our stop loss, take profit, and I talked about several things. If you haven't watched that video, do not watch this one. Don't waste your time because that's mandatory and that's the beginning of this video. That's the part 1. This is the part 2. But if you have watched that and you have any questions, feel free to ask me down in the comments below that video or this one. It doesn't matter. I would be really happy to answer your questions. But here and now today, I want to continue all those concepts and bring it all the way to position sizing, which I pointed out in the previous video a little bit. And now let's talk about another really important aspect of risk management, which brings us to risk to reward and winning ratio. These are, of course, some of the key concepts that we as traders and investors must use in order to minimize our risks and maximize our profits. In this video, I will talk about what position sizing is, how we can use it, and how we can calculate it. And after that, I will also cover everything you need to know about risk to reward and winning ratio, and how we can come up with a good balance in between them to make our trades more efficient and, in the end of the day, make some money. So, let's get started. First, let's talk about position sizing. Position sizing is the process of determining how much of your capital to risk on any given trade. The goal of position sizing is to balance risk and reward to achieve the best possible outcome. Position sizing is important because it helps to manage risk. By sizing your positions appropriately, you can limit the amount of money you could lose on any given trade. This helps to protect your capital and prevent large drawdowns. To calculate position size, you need to consider several factors, including the size of your trading account, the risk you're willing to take, and the size of your stop loss. A quick stop here. So this is the reason I've told you in the beginning of the video you have to watch my previous video, because in the previous session I've talked completely about how to set our stop loss and where to put it exactly. Now with the upcoming knowledge and data that I'm giving you within this session, you can combine them all together and come up with your own strategy. The stop loss is the price level at which you'll exit the trade if it goes against you. The formula for calculating position size is as follows. Position size equals account size times risk per trade divided by stop loss distance. Let's say you have a trading account with $10,000 and you're willing to risk 1% of your account per trade. If you're buying a stock or crypto or any other asset with a stop loss of $1 below your entry price, the position size would be position size equals $10,000 times 1% divided by $1, which means $100. This means that you can buy $100 worth of the stock, crypto, or any other asset, and if the trade goes against you, you'll only lose $1. Don't worry about this kind of stuff. You don't have to calculate them all the time because all the crypto exchanges and even brokers and MetaTrader application there are tons of online calculators, which you give them just the data that you want, the position size, whatever you want to give them, and they will come up with risk management, and they will give you the data that you need, and they doing all the stuff for you. You can just give whatever you want to them, and catch whatever you want in the end. But I'm only telling you this to be aware of the fact that you have to control these kind of things, and you must be flexible. Later on I will tell you why. Now, let's talk about risk-reward ratios. The risk-reward ratio is the ratio of potential profit to potential loss on a trade. This ratio is important because it helps you to evaluate the potential return of a trade and decide whether it's worth taking. A good risk-reward ratio is typically at least 1 to 2, which means that the potential reward is at least twice as much as the potential loss. Let's make an example to understand risk to reward ratio better. Let's think that I tell you, okay, I've prepared lunch for us, and we don't have a drink. So it is so hot during the summer, and it's in the midday, and it's up to 30 degrees of Celsius out there. Okay, you have to walk 100 meters, or let's say a kilometer, to reach the supermarket and buy a drink and come back. And you think with yourself and say, that doesn't worth it. We can make a lemonade here, or we can just drink water, and later on we can go out or we can just order a drink, cold drink. But in the same time, same situation, I tell you, if you walk 10 kilometers in this weather with the same conditions, in the end of it, I will give you $1 million. Then you say, wow, that's really worth it. So, the evaluation and how much it's worth to do something means risk to reward ratio. For example, let's make another example. If you're buying a stock or a crypto with a potential profit of $4 and the potential loss of $2, the risk reward ratio would be risk reward ratio equals potential profit divided by potential loss equals $4 divided by $2. It means 2 to 1 risk to reward ratio. A good risk to reward ratio helps you to increase your chances of success, because if you lose on some trades, you'll still come out ahead if your winning trades have a higher reward than your losing trades. In order to understand that better, let's go to the chart and make some examples. Well, if you're new to the channel and you're new to trading and you don't know what is it all about, what is this chart, how does it work, I've made completely dedicated videos about this, which I'm going to leave the link both above here and down in the description. I highly recommend to watch those videos because it's a nonsense to you if you have no idea what I'm talking about. I'm going to talk about lots of things, support and resistance areas or supply and demand zones. I'm going to talk about the indicators, divergences. So these are the things which I'm going to talk about. If you have any idea about those, it's going to be for you just having a hard time understanding what I'm talking about. But if you're already into trading and you know what I'm talking about, so just that's for you. First, let's talk about risk to reward ratio. So I'm starting by determining my support and resistance areas, which I'm going to later on go to Bitcoin chart, a live trade, let's say almost a live trade, which I took 2 days ago. It hit my target points, and I'm going to talk about lots of things. But let's determine our areas here. I'm not changing the color of the areas like the previous sessions because you already know that which is the support, which is the resistance, and when a level is going to be lost, it's going to transform itself. So for example, in this case here, it was a resistance level, then it was breached, so it becomes a support level afterwards. Let me draw everything. In this case here, let me zoom in. This is Ethereum or ETH to USDT 5 minutes time frame chart. In this case, if I wanted to take a trade, so I look at the things which let me bring my EMA 20 period lengths and my RSI, how to work with them, fully dedicated video previously, go check them out. But if I wanted to take a trade, so I had a beautiful divergence here, a big lower low, then I had, let me determine it for you again. So yeah, it was a beautiful divergence here, and I wait for the price, for some more indications for the price to go above the EMA 20. So it went here, and previously I had one bullish spinning top here. I have 3 white soldiers. So good indications. Here I could enter a trade, a long trade here. Put my stop loss here. How to do that, I talked about that completely in the previous session, how to do this. So we're going to waste no more time. That's going to be what I was talking about. So in this case here, you can see, let me remove everything to make it more visible to your eyes. Yeah. In this case here, you can see you can see this number here is 2. It means it's a 2-to-1 risk to reward ratio. If you take a look at here, these numbers, my profit would be 3.65% and my loss is going to be 1.83%. You might ask yourself, okay, my loss is more than 1%. What should I do? I talked about that previously in previous session with the data from that video and the data here with playing with our leverage and all those things. We can manage how to do that. But here and now I want to talk about risk reward ratio. So it's fixed on 2. But should it be always like this? Of course not. Lots of people, they say it must be at least 1 to 2. Less than 1 to 2 is not working out. But believe me, you must be flexible with the market. Otherwise, if you won't be flexible, the market is going to break you. Believe me. Later on in this video with other examples, I will tell you what I do as myself. I will talk about this later on a lot in my upcoming videos, but I will make an example just on Bitcoin chart, what I did like 2 days ago, and it just hit my targets like a couple of hours ago. Yeah, as you can see, so it's the true definition. It means that the profit I will take from the market is going to be 2 times bigger than the loss that I'm risking for my on my trade. That's long story short. But I couldn't put my take profit here. Why? Because my resistance level was here, and due to knowledge I had from previous session, I know that I must put my target point somewhere around here in this quarter here. So here's a rule of thumb. If your risk to reward ratio, keep it in mind for me. If you keep your risk to reward ratio somewhere in between, let's say 1.25 to 1 up to 2 to 1. That's good. In this case here is 1 to 1.25. But in this case, you have to keep in mind, which later on I'm going to talk about the session dedicated to money management. I will tell you how to manage your leverage within these trades like this. But and how we can hedge, what is hedging, and we will talk about those later on in the sessions dedicated to how to work with exchanges and how to take real orders and how to do these orders, because now we were talking about risk to reward ratio, where to put the stop loss, but how to do that, we must do this with real money on real accounts in exchanges, or in the case you want to trade stocks or commodities or even forex, you must do it in MetaTrader application. But here and now I only want to talk about the risk to reward ratio. So somewhere, the least you can do is 1 to 1. But 1 to 1 doesn't worth it that much. Later on you will realize it. For sometimes I do it when I see it's a really good trade, but I do it for step by step taking profit, which I'm going to talk about that just in a moment, in upcoming minutes. But somewhere in between, I prefer somewhere in between 1.25 to 2. Something like that. But how do I do it? I'm making an example on long positions. You can do it on short for yourself. If you have any questions, you can just ask me. Let's go to Bitcoin charts. And what I did was like this 2 days ago. Let's bring everything up. So I drew my Fibonacci levels, and by Fibonacci levels, I set my target points. These are my support and resistance areas, my Fibonacci levels. I talked about those. Check the links down below. I'm going to leave a link above here too. Then here in the market, I decided to take a long trade. Here, exactly here, my leverage was 10. and my stop loss was below this shadow. So my first target point was here. So you can see it's more than, I'm sorry, it was here. It was exactly at 1.25. So what I did was let's say I've entered a trade with $100. So my first target point was here, and I came out of the trade like 50% of it. So as you can see here, it was 1.81, let's say 1.8% of profit. So with the leverage of 10, it was like 18% of profit. 18% of $100 is $18, but I got out of the trade with 50%, so which makes it $9. So let's put it here. And it was with 10x 9 USDT. Then what you should do here, you must save, we call it the trailing our stop loss. You must remove your stop loss from here and put it here on your entry level. So when the market, so it hit my target point here. If the market turns back against you, so you will come out of the trade with the other 50% without any loss. We call this making your trades risk-free. Then I had another target point, which was here in this area. So I took out of a trade here. So let's say I didn't take another trade. I was in the same trade, but so I have no loss here because I made my trade risk-free. So I am in no risk at all now. If the market goes down against me, I will lose no money, although I made even $9, 9 USDT. So it was another trade I've entered here. So my trade is now risk-free. If the market goes down by reason or whatever it is, I won't lose any money, although I made 9 USDT too. So here, what I did is I'm continuing with another 50% of my trade, and I set an order for 25% here. You can do the calculations for yourself. Each time the price is going to hit my new target point, I will take my stop loss on the previous entry. Let's make an example, not to make you confused. So my first target point was here. When price hit my first target point, I remove my, let's say I move my stop loss from here to my entry level. Then the market goes up and hit my next target point. So I take my stop loss and put it on my target point. And then the price hits my next target point and I remove, and just like that. So I got out of the trade 50% here, 25% here, and another 25% here. And I made a really good deal out of this trade. I'm doing the math for you. So I had $100 and my first target point was here, 50%. Okay, minus 50%, it equals to $50, of course. So $50 had a profit of 1.74. So it times 10 because it was a 10x leverage. It means 15.4 plus percent. 58.7. Let's write it down. It was not accurate. It's almost 9. 58.7. And then I remove it. I have another $50. How much profit was the rest of the trade? It was like from here. So I had, don't mind this risk because we entered the trade here and now our stop loss is at this point, so don't mind this. Let me change the color not to make you confused. Okay, so from here to here was another 2.828%. So I just bring up the calculator. I've got $50 left, but I've got out of the trade here with 20%. 25 means the half time of it, so it was $25. $25 plus 28% profit. It was a 10x leverage, so it was like 32. I have here 32. And then I have another $25 here, which I go all the way up and I move my stop loss from here to here. And then I come all the way up here. It was another 20%. Yeah, so $25 left, $25 plus 20%, $30. Let's now make do the math here. And it's so easy. 58.7 plus 32 plus 30. $120. How much I had in the beginning? $100. I made $20.7, let's say almost $21 in this trade, and it is amazing. So if you want to calculate how much percentage I made, so it was 117.5 almost percent here, 128% here, and 120% here. But it was not all on $100 because I came out of the trade each place I had a target point. So this is so-called risk management, of course. Beginning of the subject which I want to talk a lot about in the upcoming sessions, the money management. And by this technique, you can just make your trades risk-free. So to sum it up, let's make an example. Let me just delete everything. Let's go to another chart. Let's go to, imagine we have two people and they want to make like 8 trades. The first person is Mike. And both of them, let's say Mike and David, they both have $1,000. Or let's say USDT. And they want to trade with the risk to reward ratio of 2-to-1. All right. So it means that their wins are going to be like 2 times bigger than their loss. But Mike is going to risk 250 USDT in each trade. David is going to risk $30 or USDT per trade. What happens? Let's imagine first 4 trades are going to be losses. So Mike is going to be like 1,000 minus 250 first trade, another 250 next trade, another 250 third trade, and another 250 fourth trade. He will not even reach the other trades, the other 4 trades, and he becomes 0 or wiped out at this point. But in the case of David, we have with the same criteria, same thing, same story. So $1,000, he will going to lose $30 in the first trade, another $30 in the next trade, another $30 in the next trade, and another $30 in the next trade. His money is going to be how much? $120 are going to be out of his account, so $880. Then he will make money like his wins are going to be 2 times bigger than this, so $60 on each trade. This is, so it's going to be plus 60 plus 60 plus 60 plus 60, and it becomes, so it's $240, which makes it $1,120, or let's say USDT. So the first trader, without proper risk management, who was Mike, he wiped out his account in the first 4 trades with the same criteria and same trades. First 4 trades going to be losses. So David lost like $120, then he made $240, and now he is $120 more than his capital account, which was 1,000 USDT. So this is a long story short. Finally, let's talk about winning ratio. The winning ratio is the percentage of trades that are profitable out of all the trades you take. A good winning ratio is typically around 50% or higher. The winning ratio is important because it helps you to evaluate the success of your trading strategy. If your winning ratio is high, it means that your strategy is effective and you're making money. If your winning ratio is low, it means that you need to adjust your strategy or risk management, which most of the times it's all about your risk management. Because if you even choose the shittiest, the most crappy trading strategy, in the end of the day, with a good risk management system, you can make money after a while. A while here, which you can evaluate your and give some weight to your winning ratio, is mostly each 100 trades period. So if you're trading on lower time frames, you can evaluate that, or let's say you're scalping. You can evaluate that sooner. If you're trading on higher time frames like daily, weekly, that may take up to weeks, months, or even years. So first we must come up with the fact that in which time frame we want to trade in, and then after each 100 trade, evaluate our winning ratio. And for example, say out of 100 trades, how much of them were wins, how much of them were loses, how much loses I had right after each other, and how much winnings I had right after each other. Then we can come up with, this is the reason I'm telling you, you have, all the things that I'm telling you, it's not something I inject into your veins. It's all about, on the other side of the coin, it's all about the experience. You must experience it for yourself. Even if you market watch or do demo trading, it's not just like the real world. Let's make an example for you. I can remember back at my university when I was trying to become a pilot, and we had these simulators, and they were really good to reduce the cost of lots of teaching stuff instead of just flying with a real helicopter, just going to the simulator and do it for yourself. But in this case, you had a lot of time to learn lots of things instead of flying and burning lots of fuel and putting ourselves in danger. But there are things that you cannot feel properly while you are within a simulator, like the real world feeling of having a sudden descent up in the air. So here in the market is the same. You can practice, and learn a lot of things, like thousands, millions of things while you are paper trading or demo trading or market watching. But when you bring your real money in the market, as soon as the money is getting bigger and bigger, the challenge is becoming harder and harder. Believe me. And that psychology part of the market, that risk management becomes more bold, and it becomes more important. That's the reason I'm telling you that this is not all about theoretical things in which I'm telling you. You have to focus and practice and gain a lot of experience for yourself. And I'm always there for you to help you out with any questions or difficulties you have. So there you have it. You see how important it is? You have to mix everything I've told you about this session plus previous session. Come up with your own plan. And if you're already into trading and you're here to get some answers, so there you have it. But if you're new to trading and you're new to this channel, you have to go and start my videos from the scratch, which is starting from module 1, season 1, episode 1, of course, which I'm gonna leave the link both above here in the end of this video and down in the descriptions. So don't miss them, because all these sessions are oriented one after each other like the chain, and you have to follow them up in order to become successful in the financial markets, especially now as we're talking about cryptocurrencies. So did you like this video too? If you really like it, please hit the like button and subscribe to my channel if you haven't yet, and by turning on the notification bell, you're gonna be the first to be informed when I'm gonna upload a new video, which I'm doing on daily basis, and share my videos with your friends who are keen to learn all about this unknown world of trading, especially cryptocurrencies. Thank you for watching. See you in the next one.